All right. Welcome, everyone. I think we can start this session. Thank you, all of you to be here. Thanks all of you to be actually at the Finance in Common Summit, this 4th edition. So we wanted also to have this discussion around what banks do, and we really want this discussion also to be practical on what are the challenges we are facing as public development banks in the way that we put our operations and also the constraints we are facing. So while we are discussing how to scale for better impact, I think we should also have this discussion on what are our constraints and how we can solve it. And by this discussion, we came to have it this proposal of sessions where we have high practical people which are involved in banking system, public development banking system for a long time with huge experience, I may say. So how to solve public development banks' financial and regulatory constraints to scale up SDG finance and build up resilience. Now for this discussion, I like to thank and welcome our chair today, Leslie Masdorp, Vice President and Chief Financial Officer of the New Development Bank. We will be very glad to hear from you on setting up the scene and probably also giving insight on how this discussion can be useful to all of us. I am Adama Mariko. I'm Secretary General of Finance in Common Movement, but I'm here probably moderating, not as Secretary General, but our former head of financial planning, all this finance stuff within bank, which is my background. President Serge Ekwe from the West African Development Bank. So you have made tremendous operations lately in the African area. So we'll be glad to hear about those innovations as well in the banking system. President Jean Leon from the Caribbean Development Bank. So we also will be having the pleasure of hearing you. JP Morgan DFI, Fahin Alibrey, thank you for being here as well. We have also Dr. San Bilal joining us for discussing also in a perspective of what think tanks have also noticed in one of those conferences and probably summarizing up the discussion we will be having today. Leonardo Pupetto is Vice President from Sovereign Advisory in Lazard. You have many clients, different clients. Some of them are states, some of them are banks. So I think you are playing an honest broker role in this. So let's see how financial innovation is going up on this way as well. Samia Peiva, Chief Risk Officer of CAF, with a long experience in the private sector, both in the banking and insurance. So I think also you can make quite a few comparisons on what I have noticed so far. Fidel Jaramillo, Secretary General of FLAR, Federal Reserve, and so we'll also see the perspective from regulators and monetary aspects. And Jonas Enrico from TCX, and you know that this discussion starts actually with TCX during the Finance in Common process. We were asking ourselves, so how we manage also, while we are speaking about this local currency issue within development banks. So we conducted a joint study, and Jonas will have the pleasure to present us this survey, the conclusions we have, and probably the solutions we can figure out. And thanks also to our friends from S&P. Many of you has raised the matter of the price of capital and how the rating is involved in this process as well. And very glad that we can have this discussion also in presence of S&P. So without no further ado, I'm going to share the floor first to our chair, Leslie, and then Jonas will come up with the study. Thank you.
Good morning, everyone. Thank you very much, Adama, for the invitation to make some scene-setting remarks for this session today. I'd like to start off by saying that some of my remarks is also aimed at sort of provoking our very esteemed panel we have here so that they can express their own views on some of these opinions that I will express. Maybe the first point to make is that, I come from the New Development Bank, which, as you know, is a new multilateral development institution, was only set up way back in 2015. In that regard, as a new institution, we had the, if you like, the sort of license to innovate in the sense that we did not have a blueprint as to what journey should be followed to create this institution. We could ask the questions of first principles. Why should we try and be a AAA? Why are the capital adequacy metrics the way they are? Should we be as risk averse as is dictated by the sort of risk management policies of MDBs, and so on and so on? What's the split between public sector versus private sector? What is the bank's risk appetite? All of these questions we are to address through the lens as a new institution. The second key point to make is that I would say over the last 10 years, and here I very much want to give kind of an overview of what I believe would be a bit of a stock taking of what really has happened over the last 8-9 years or so, because as we go into these conversations, there's a backdrop and a history to it. So I just want to have some brief reflections on that, and then maybe end off with where are we now, what is currently taking place, especially within the MDB reform agenda of the G20. I should caution that from the outset, my comments are mainly directed towards the MDB agenda, and it's not necessarily all rooted within the constraints that face the national development banks. We have also significant representation from that sector. In kicking off, what I'd like to highlight is that, in my view, and I'm sure you would all agree, the G20 has been the most sort of preeminent sort of body that has led the reform agenda of MDBs quite ably over the last 8-9 years. Starting way back in 2015, when the G20 put together a series of recommendations. It was broadly called balance sheet optimization. And what that essentially means was whether we are using the maximum extent of our capacity. Are we stretching the dollars? Are there inhibiting factors within the structure of the balance sheets of these institutions that is limiting our ability to expand our lending volumes? I think a defining sort of milestone or moment for this discussion today, I would say, is 2015. In 2015, July, there was a meeting that took place in Addis Ababa. It was the United Nations Financing for Development Conference, and it came up with what's called a AAA agenda, the Addis Ababa Action Agenda. And it was really in 2015 where the major consensus was arrived at that the capacities of development banks are significantly limited in terms of the size of the developmental agenda, because the UN at the time, as you know, were just preparing to, this is 2 months before the SDGs were adopted in September. It was very clear that there's no way that development banks will be able to execute on this agenda of the 2030 Sustainable Development Goals. So the major realization from that summit was that we need to find ways to crowd in, to mobilize, to leverage private sector capital. I mean, the first submission I want to make to you today is that we have largely failed in that regard. If you look at the last 8-9 years, it's very clear that we have incrementally made progress in mobilizing more institutional investor capital into the development agenda, but it is rather in sort of modest form. So we've got to identify what are the more principal and fundamental obstacles and constraints why we have not succeeded in that regard. The second or third point I'd like to make is that multilateral development banks, and coming from the MDBs, it's easy for me to be critical and self-critical because, I come from the industry. I would argue that our institutions are very, very conservative, right? So way back when the institutions were formed, the logic at the time, as you know, the World Bank was created in the aftermath of the Second World War. And if you, which we did when we started the New Development Bank, look at the archives of Bretton Woods, and it was very clear that at the time there was an aim to inject confidence in the financial markets. So our whole idea of creating a AAA institution was meant to project confident so that, investors out there can buy our bonds, which with a low rate of interest that we pay because of our high credit worthiness. And that model, the core business model of how the World Bank was created, is very much still in place today. There's been little reforms over the years, but in essence, the financial and business model of MDBs have remained largely the same since 1944. Why do I make that point? I make that point in saying that the logic of why MDBs should be AAA rated was also put under scrutiny and subjected to a process within the G20, which led to the capital adequacy report that came out last year. The New Development Bank made submissions into that process. And by the way, this was not the first time it was done. It was also done in the 2018 annual meeting of the World Bank. There was another report submitted then called Making Finance Work for All. And it was done by Tharman, who just became the Singaporean president. He led that report, Eminent Persons Group report, and he came to the conclusion that the regulatory obstacles that MDBs face, some of them are actually self-imposed, meaning that our financial metrics, for example, do not take into account the big numbers, large volumes of callable capital that we have. And for those of you not familiar with MDBs, we essentially have two classes of capital. We have paid-in capital, which is equity, money that came from the governments, and then we have callable capital, which is really like a contingent capital, or it's like a guarantee, if you like. You can make a call on that capital if you need it. If you cannot service your bondholders, or if you can't redeem a bond, you have that ability to make a call. In the 80 years now, 79 years to be exact, of MDBs, there's never been a call on capital. And the reason for that is that MDBs have created such a risk-averse and strong and very conservative balance sheet that there's never been a need to make a call on that capital. So one of the conclusions that the G20 came to in that 2018 report was that MDBs have been too conservative in their own capital adequacy metrics, and that there is scope and space for us to include at least the highly rated, the AAA and the AA plus rated callable capital into our capital adequacy models, which will enable us to have more lending headroom. So when you look at these now four major processes over the last 10 years, firstly, the balance sheet optimization, which was all about, for example, doing exposure exchange swaps. I was just talking to some colleagues here about how you can reduce the concentration risk, for example, that MDBs face. And those measures were all started to be introduced in around 2016, when the Inter-American Development Bank, World Bank, and Africa Development Bank put the first exposure exchange swaps in place. Another point that I want to sort of leave with you and provoke you is that the most of the reforms that MDBs have been going through over the last 8, 9, 10 years or so have really been driven by shareholders, by people outside of the bank. So these financial instruments, for example, they're not rocket science. Those of you who come from the world of finance will know that, for example, doing synthetic swaps of the kind that the MDBs have done is a pretty standard sort of instrument. And yet we needed the G20 to propel and push the institutions to do those swaps. We have thousands of people with master's degrees and PhDs within the MDB system, but they were not the ones to, for example, come up with these ideas. Another measure that was implemented also during that time was consolidating the concessional window and the non-concessional balance sheets of the MDBs through literally a stroke of a pen. In 2015, 2016, the Asia Development Bank, as an example, by combining and using the unleveraged equity within their concessional window, by bringing these two balance sheets together, they're able to free up or create additional lending of, I think it was the order of sort of $20 or $30 billion per annum, may I add, just through a simple innovation. Similarly, the World Bank started to, through IDA, to raise capital through the capital markets, because they realized there's pockets of capital lying idle within the IDA balance sheet. The key point I'm making there, I won't go into more examples, is that there's been a risk aversion embedded in the very manner in which our institutions operate, and that is a function of the high credit rating that we have become accustomed to. Next point to make, and this comes out of the most recent report of the G20, which is currently, it's called the triple MDB triple agenda, is that there are ways in which MDBs can find opportunity to raise fresh capital. So hybrid capital, and I know one of the panelists will speak about hybrid capital, is a new instrument that we will now be able to deploy, which has got, as you know, hybrid between the debt and equity. It's got features of both debt and equity. We will now, because rating agencies have accommodated this in their methodology, we'll be able to raise fresh capital in that way. In addition, there's also been for several years now, the Africa Development Bank has led a charge for us to find a way to better leverage and use the SDRs. SDRs, as you know, has really been unutilized in the sort of financial structure of the IMF. So there is an idea now to leverage SDRs, or rather to recycle SDRs in a more creative way. In the interest of time, I'm just going to sort of make a couple of more comments to define what I see as the sort of key elements of where is the developed MDB system going. And there's about, I'd say, 6 or 7 major changes that will shape the way the institutions will work in future. The first one is moving away from financing projects to looking through a much more portfolio approach. Now, MDBs finance individual projects on the back of their own balance sheets. This has worked and obviously works very well, and we hold those assets or these loans on our books up till maturity. It does not make sense in this way that it is possible once you have gone through, let's say, if you have a solar project, for example, when there's no longer construction risk, the project is already generating power, there's cash flow coming in, and you can project those cash flows into the future. There's absolutely no reason why we cannot on-sell those assets to the private sector, creating headroom for new lending going forward. So the first one is just moving from a project approach towards more portfolio approach, and then secondly, looking at securitization as an instrument is also going to be a critical part of that design. The next major change is also a move away from the single focus just on lending in US dollars and a greater use of local currency. This does not mean de-dollarization. It simply means develop local capital markets and use that in a way to allow countries to avoid the foreign exchange mismatch if they borrow in hard currency and the revenues in a project is in local currency. After the depreciation of local currency, you often have to pay back a much higher amount. The third area, which I already sort of touched on, is the way in which we assess our capital adequacy metrics and their scope now, because the rating agencies, which in the past have very much been seen as black boxes. No one really questioned rating agencies in the past because they were seen as almost the de facto regulators of the industry. But there's now been active dialogue with them, and there's a greater openness to has used less conservative risk capital adequacy metrics. Another element as part of the change is risk transfer instruments. As you know, specifically the institutional investor community, for them to participate in the agenda of financing sustainable infrastructure, they've got certain Basel and other constraints. So we need to find a way to crowd in private sector capital by ensuring that we are able to improve the risk return profile of projects. In other words, be much more catalytic in the way that we finance as opposed to just financing it fully on our own balance sheet. And then the next element, which is now captured in the World Bank's evolution report, as you know, is to integrate the global public goods into the development agenda in a much more granular way. So we cannot just simply say or decree that we will finance climate change and we will finance loss of biodiversity and all of these and pandemic preparedness, etc. It is just an additional part of the development agenda. That is not the correct way to look at it, because, as you know, many countries, for example, in Africa, where the development development agenda is most acute, Africa only contributes about 3.8% of global greenhouse gas emissions, and the development needs are the biggest. So if we're going to shift funding towards the climate agenda, that funding will be directed towards middle-income countries like China, like India. China contributes 27% of global greenhouse gas emissions. So the latest report of the MDB Triple Agenda talks about almost as if there is a natural sort of symbiotic relationship between financing climate and financing development. There are clearly trade-offs there. So we need a much more granular sort of climate window that we can introduce, which we define and explicitly recognize the trade-offs to make sure that the poorest of the poor countries and the low-income countries are not marginalized in the process. And then finally, the idea of having country platforms where instead of us just doing work in South Africa with the Development Bank of Southern Africa, we will have a window into what is the Africa Development Bank doing with South Africa or with Benin or Nigeria or wherever the country might be, to bring together the development banks in a much more platform-like style, and that we can work more as a system. And this is where Finance in Common become a very important movement, because it really is filling that gap of our institutions functioning as sort of individual agents rather than us collaborating more in a system format. I'll pause there in the interest of time and give over the floor back to Adama.
Thank you very much, Chair. Thank you for this large and deep perspective on the constraints and also the way we can and deep and delve in some solutions you have brought. Thank you very much for that. I'm going to turn to Jonas. Let's dig into one of the aspects that were raised about local currency, and this we checked the issue not in the part where we are facing our own borrowers, but even within the bank itself. How do we manage our own resource mobilization and our assets in different currencies? So, Jonas, over to you.
Yeah, thank you, Adama. And I think there is a presentation I'm going to start in a second. Well, I'm going to touch upon only one of the points that Leslie mentioned about local currency and FX. And this is part of a study that has been conducted by TCX together with Finance in Common and AFD. And this has provided some insights on the situation right now specifically for Public Development Bank and the ability to reach sustainable development goals. What we look is at specifically at currency depreciations that are just one of the events that tend to happen more and more often in the world we live in. Without further ado, so first of all, what do we look into? We ran a study where essentially a survey was circulated among public banks across the world. You can see on the bottom right who answer. From Africa, Europe, Latin, and Asia. So we know that public banks, public development banks, play a pivotal role in financing sustainable development goals. What we also know that they rely heavily, still to today, from foreign funding. Dollar coming from different sources, mostly multilateral development bank, and they tend to run the risk on this dollar quite systematically. And we wanted to know what they do and how they manage it and how they're doing in the end of the day. So let's go straight to some numbers without further ado. So the first reason is why Public Development Bank, they receive dollar, they're financing dollar, is that most of the time they have no other alternatives. So this is what is offered to them, and from international capital markets, the local capital market tend to be not deep enough. So you have essentially public development banks with around, they inform us that around 50% of their loan book to their own client is dollar denominated, which is a pretty big portion, and this is like reported by 32% of the surveyed institution. And then you have like 2/3 of the public development bank that they clearly say that they are exposed to foreign exchange risk. And this is is identified as a major risk that they run. I mean, 2/3 is a high percentage, obviously. And they just, yeah, this is what they are left with without not too many means to manage it then. So they also say that the 25 of the respondent indicated FX risk has previously led to scale back, postponements, or cancellation of funding agreements. And this is like also to be linked on the macroeconomic situation of the country and how this position can affect their own ability to serve debt, to provide funding to projects and so on. So how do they manage it? That's one of the main topic. We were a bit, I mean, not shocked, but because probably we know it already, that they say 36% of the respondents say that there is no protection on their liability in dollars, so they're actually taking the risk. They don't even provision for such risk in their income statement. This was reported by 47% of the respondents. And what we can see is that they do understand, like public banks do understand the risk they run, because if we look at the fact that they run a stress test, they check, they have policy in place. So it tells us that these institutions are not unable to manage it. It's not that they don't understand it. Actually, they understand it pretty well, but probably are left with no alternative. So they say that what are the reasons why they end up being with these exposures, that there is no availability of local currency loans coming from multilateral development banks. There is no solution locally. They cannot maybe access the local market in the volumes that they need, and obviously they cannot dry up a local market. And well, that's what may be concerned from TCX more closely, that the FX market is rather illiquid. So derivatives are maybe not developed yet locally to fill in the gap that they found. And then there is also like a third topic, that is human resource constraints. You also need to have people that obviously, I mean, that can help with the treasury team's client solution team. So to continue, so that's what was more telling, and that's why probably, just to follow what Leslie say, only 17% of the respondents of this public development bank currently receive local currency financing from MDB. So we have a pretty large gap of institutions that are not accessing their functional currency for financing themselves. They mentioned that obviously there is a high demand or a sizable demand to have access to derivatives, to guarantee blending solution and local currency from NDB, but this is not the case yet. It's just a wish for the moment. So just to wrap it up, what is the way forward here? So definitely there is one component that is strengthening domestic capital markets, having effective regulation in place, supervision, so that there is a possibility for local development bank to, even in their own market, to have access to liquidity, to have access to products, and yeah, like it's in a developed market. But probably the recommendation that is more important is promoting local currency financing and lending from NDBs to public development bank. That would solve a major problem and protect, take off entirely the risk that there is right now that comes from dollar loans or euro loans or pound loans. Then the recommendation number 3, that's what TCX plays a role. to a certain extent is that enhance the solution offered by hedging providers. So there is derivative market that are more and more developing. TCX obviously has been like a pioneer in offering solution in all markets, regardless of the size or regardless of the maturity. So offering these products and make them available to clients, to public development banks is fundamental, and also like through technical assistance, through knowledge sharing, can really help to improve the situation. The fourth recommendation is more related to blended finance, and again, we have started. There are multiple programs also managed by TCX that can have a component of donor funding or guarantees that can support the promotion of these products. There is a first loss scheme, concessionality, risk-sharing mechanism that we currently have in place and that can be replicated. We have one that has been, well, maybe very new that we created, TCX created with the European Union for a market creation facility to essentially decrease the cost of hedging for very frontier markets in Africa and in the MENA region. Again, to tackle the cost to decrease essentially the cost of financing for many clients in these markets. And then there is a recommendation number 5. This is reinforcing their internal capabilities. We do it on an informal basis on ourselves to train as much as we can these clients, talk with public development banks, private clients, corporates, whoever calls. So obviously we are doing it in a more structured way. We are trying together to mobilize resources with blended finance, collateral guarantee programs. We signed memorandum of understanding also with the governments, with Ministry of Finance, for example, to help them to think about like which risks they have in their public debt, essentially, to convert it if possible. And obviously, like the next step is probably also to help the smaller public development banks, the smaller that they have maybe less resources, to think as much as possible to this problem and try to tackle it before another depreciation hit. Yeah, and with that I wanted to close also in the interest of time and pass it back to Adama.
Thank you very much, Jonas. Probably there will be, because we will spare some time for the Q&A also. So shall we move with the next speaker? Probably just mention that this study is available. There is several data has been shown, but if you want the background data as well, the survey is available on Finance in Common website. So also will be shared on the deliverables of this summit for those who want to. Let's stick on this issue of currency risk mismatching, and I'm going to turn to Joyenta from Trade Development Bank in Africa. How are currency fluctuations impacting your clients and your institution as a lender, and how do you, as a chief risk officer, I mean, what a job! How do you mitigate this related risk on your operations so far in the region and yeah?
Thank you very much. I believe it is still morning, so I can say good morning, everyone. The question asked about currency fluctuations is real, because we are a dollar-denominated institution. We borrow in hard currency, and we deploy those resources to our member states and our clients. And the facilities are also granted in hard currency. the challenge most of our clients are facing since COVID-19. Before COVID, we would see maybe challenged clients from different member states, but from time to time. It's now becoming almost the case for most clients because of the strengthening dollar and their ability to mobilize hard currency to service their facilities. Of course, their businesses were affected by the pandemic, and thereafter a series of crises and geopolitics and commodity prices, name it. So the challenges they are facing is real, because we don't see it stopping, and even those that were investing in these currencies, they are preferring for safety. Buying euro bonds is more stable, and investing, because they are paying so well, the return is good, their money is safe. They don't see why they should keep their money within our economies if the local currencies are seriously depreciating. So it is a challenge. And one of the speakers mentioned that, yes, they know the problems, but they don't know how to go about them. We were trying, finding solutions in some few cases before COVID, because everything was moving on very well. We could work with local markets to issue local currency papers, but we would work with, of course, local players, where we would mobilize some deep-pocketed players, such as pension funds, because they have available resources, and you work with the capital market and the providers of those players with excess currencies, and you could issue a local paper, but we would immediately deploy the proceeds to the member state. We had, it worked so well in East African countries, and it was really successful, but that was the simplest way of hedging the currency risk. We are in talks with TCX, and we've signed a memorandum of understanding on how to do this. We are aware of the costs involved, and while we're very much willing, we intermediary as an institution, so whatever solutions we work on should make some kind of meaning to our clients. So we really seriously discussing on this mechanism of how to make it work, how the arrangement, the environment is made conducive by policymakers in the member states, convincing our borrowers that there is a solution, because there's that need to get hard currency, maybe for importation of the goods and services, equipment, understandably, if there is difficult to get forex, to mobilize resources on the local market, it becomes a problem. So the assignment we have at hand is to ensure that we work on a mechanism of working out a solution with our partners. We also, we did discuss this with the World Bank as well in the previous engagements. So we are aware that a solution is possible, And we want also players to be convinced that this is something worth going for. We have some limitations. We talked about underdeveloped capital markets. This is, something that is, of course, a threat. And we're also seeing fewer players on these markets. And also the challenge of skill set to give these solutions, to innovate further, because there are so many solutions that can also work back home, but we need alignment of minds and also people taking it seriously to be a priority to make sure we serve better our clients and our people. So we're trying to also help our clients by capacity building initiatives. We do have TDB Academy, where some members come. Once they have expressed a problem, then we try to get a number of people who need such a training. We conduct the training, but we're also seeing some capacity or capabilities lacking in terms of systems to do these solutions. So basically, that's where we are. Okay. We're seeing willingness to do more. We're seeing more partnerships. We're seeing willingness to collaborate further to work out solutions that can serve our people better. And we also remain committed as institutions, bearing in mind that we are intermediary institutions. So our intermediary role remains, and we also need to make sure that, yes, we take care of our people, we take care of the planet, and make reasonable return if we are to remain also in existence. So it's a very challenging trade-off, but that's how we stand, because we pride ourselves of the triple bottom line agenda, which is not easy, but we're seeing it happening slowly, and we're seeing more partners committed to these initiatives. Let me stop there.
Thank you. Thank you very much. I'm going to just jump right to your neighbor, because I think these discussions are really related. We have a perspective from Africa, of course, and I think CAF is facing probably the same challenges in the region, in Latin America. So I want to turn to you, Samia. What is your observations? And when I thought of this question, I was also thinking, so how your personal experience from, private banker, risk officer, joining in recently the public sector and the public development banks, specifically a multilateral development bank. So what are your views on the operations you are running in the region and the constraints you have seen probably when you arrive in these functions, and what are the solutions you probably are recommending internally to CAF, and which can be useful to others probably?
Good morning, and thank you very much for the invitation, and thank you for coordinating such an important event, and especially in this workshop, because I do believe that this is very well organized with several aspects and views from the same issue. Thank you very much. I would like to, before starting, give some context, and I think that I'm going to refer several times to what Leslie has mentioned, because you asked us to comment on your talk. And in the recent definition of CAF strategy, On top of the main objective of to become the green bank of the Latin America, several specific objectives have been defined, specifically the ones to cooperate and to leverage the subnational institutional capabilities and to mobilize resource. I may mention this because for me it's very important that the organization has explicitly objectives, quite quantitative indicators to address the main objectives related to SDGs and related to how we deal with the public development banks. And it helps the organization as a whole to focus and put all the efforts in order to achieve such objectives. So in this context, that I'd like to mention that our public development banks play a very special role and are one of our main partners in achieving the SDGs, because they are able to, of course, achieve and find the audience that we are not able to find as SMEs and small and medium entrepreneurs. And they know, of course, their markets better than us, and this is the way that you can leverage on their risk management practices and support them with our capital. And just lending, as you mentioned, just lending from the private banking, and I think that this is the main reason I'm here, and also as mentioned by Leslie, not only the new banks can make questions, but people that come from the private sector make a lot of questions, and I think that is and I'm glad that I'm arrived exactly this time where we are discussing this type of discussion, raising question about the power that the multi-development bank have in order to optimize the capital. So instead of finding constraint, I would say that I found in CAF a lot of opportunities, and opportunity that you have addressed already. And I'm glad to say that a lot of things that Leslie has commented we have already started, and that's a good beginning. First of all, we have started our review on capital adequacy and risk appetite frameworks, and these both are of paramount importance. Of course, that this also must be accompanied by reinforcement of our governance and engagement with the credit risk agencies. As any other NADB, which craves to protect the balance sheet, the rating, CAF is a very conservative one, cannot be different, and has the risk appetite aligned. But nonetheless, we have recently reinforced our risk area. I think that, I believe that the fact that I came, it's one of the reasons. And we have recently reviewed our processes, risk methodology, risk models, and also look for opportunity to improve our internal capital model and risk appetite metrics. We strongly believe that this will enhance CAF strong currently risk and capital management practice, and we, of course, will use better our capital and allocation. The second important message that I would like to mention here is everybody's talking about the same, collaboration and cooperation, but this is absolutely true. Okay, in this example of this workshop, I see at least 4, 5, 6, 7 opportunities to collaborate and cooperate in the next months. And we have to live from talk, and do. And I believe that we can live from this event with a lot of new partnership with new ideas, because indeed this is what I believe that we have to do. We can do it by ourselves, yes, we can, but it's going to be much funny if you do together with our partners. And I think that we can leverage the power that we have currently. And this is what I do believe. In CAF, we're exploring concrete opportunities with other MDBs for risk diversification ideas and look actively for learning from the other MDB success initiatives. I'm gonna have a call with Joy here today to understand better what they are playing, because I think that we have to learn and we have to share the experience. And last but not least, I'd like to mention that we have to look for innovative products. And also, this is another a strategic object in CAF, and it makes that there are a couple of people looking for these opportunities in terms of creating new products. Recently, we have established, developed a credit guarantee for a partner to protect its SME portfolio. And the idea is to transform this in a plain vanilla product to offer to our other partners, and to make it easier for other partners to have the same product. But in the main message that I would like to share with you guys is everything, in fact, is related, right? So if you're talking about, as Leslie mentioned, if you're going to talk about the capital adequacy, you have to, you have to cooperate. We have to share our ideas together. And if you want to have more innovative products, we have to do it together. And so everything is related to cooperation and collaboration. And I think that together we're going to be stronger. And this is what we have to do. So, and another message that I would like to share with you guys is that to put those objectives in a very clear and preferably in the strategic agenda, because it's the only way that the organization can pursue, can have clear objectives and indicators, and can push this agenda, because this agenda is not easy. As Leslie mentioned, this is going to be like a change mindset for our MDBs, and this must be in our strategy. This is what I'd like to share with you guys. Thank you.
Thank you very much, Samia. Before I get to President Takeaway, I'm going to just turn to Fidel here. But one comment on what you said. Usually when we do these financing common summits, we tend to have people sending, of course, I'm really glad we have two presidents of institutions here, but we don't used to have technicians on board. And of course, we'll have the technician from the water sector, the energy sector, I mean, those who are in the operations somehow. But I'm really glad around this table we have also CFOs and former CFOs or chief risk officers. Because this is also what matters to us, to see how the decisions that are being made, how we know the technicality of it and the discussions we have with regulation, etc., etc. So it's very useful that we connect also this world, and of course, very looking forward that we can, through financing common, also make these connections and sharing knowledge and problems, something real forward. So Fidel, please tell us about also, the examples that FLAR's policy and concrete actions, to strengthen domestic markets, also where the perspective of a regulator can come through. Thank you.
Well, thank you very much, Adama. I would like to thank very much TCX, AFD, and Finance in Common for inviting me to this panel. Let me begin my remarks restating a key idea that has emerged very clearly in this panel, in this discussion, and also in this summit. In a world where there's higher risks and larger unexpected shocks, the role of multilateral financial institutions as ourselves becomes crucial to mobilize knowledge and resources, not only to help countries achieving the sustainable development goals, but also to prevent, mitigate, and manage risks in a very challenging future. It is very clear that multilateral institutions should increase their capacity to provide financial assistance to countries, which will require more capital, liquidity, and relevant instruments. In other words, strengthen the robustness of our institutions. At the same time, we need to build more resilient financial institutions with more flexibility to adapt to a changing world. This will require innovative governance, products, and processes that will respond to the needs of countries. In other words, to increase their resilience. So robustness and resilience, I think they should be the building blocks of global financial safety net. As runners know, and I see some of you running this morning, we need to build muscle, but we also need to do some stretching to run faster and safer. Your question, Adana, is a clear example of how to increase resilience and relevance to strengthen domestic markets and mitigate exchange risks. Although FLAR's mandate does not address directly the issue of domestic markets, through its instruments, it contributes to achieving macroeconomic stability and financial stability, which is FLAR's central mandate, and thus the expansion of domestic capital markets. So you ask for an example. So let me give you a concrete one. As a consequence of the pandemic and the Russia and Ukraine war, Costa Rica, which is a member country, was facing a number of negative shocks. Collapse in tourism, higher oil prices, and capital outflows took a heavy toll on their balance of payments. As a result, the colón, the local currency, depreciated in over 16% and very rapidly, and external reserves dropped in 25%. In a very highly uncertain world, domestic markets were shrinking. Dollarization of assets jumped from 35% to 39%. And cross-border holdings of the pension funds were increasing at a rate of 120%. So very uncertain world and highly volatile capital markets. In this context, FLAR approved in August of 2022 a sizable balance of payments loaned to the Central Bank of Costa Rica for $1.1 billion. It was sizable because it accounts for roughly 20% of Costa Rican external reserves. For a first time to a central bank, FLAR and TCX explored the possibility of adding a tranche in colones to this loan. It didn't materialize this time, but it's a very innovative structure that we are considering for future operations. This transaction, this operation, together with other factors, of course, played a key stabilizing role in Costa Rican exchange market and its economy. Since its approval, the colón has continually appreciated by more than 20% since the disbursement date. Central bank reserves increased from over $6 billion to over $11 billion. So it was a complete change on dynamics. This increased macroeconomic stability led to a significant recovery of domestic capital markets. Financial dollarization and capital outflows were reversed. So FLAR's operation was followed by significant financial assistance of the IMF, IDB, AFD, CAF, the World Bank. And it's a clear example of multilateral coordination and cooperation. It was a massive financial assistance to turn over the story of this, of a turmoil in macroeconomic instability. Moreover, the Costa Rican MB spread dropped to levels below Latin American averages, and that allowed the country to return to capital markets and issue a $1.5 billion in relatively very favorable terms. Summarizing, FLAR's loan strengthened confidence in the macroeconomic adjustment process of Costa Rican economy, which was a key component to strengthen domestic capital markets, which was your question. We are convinced that regional financial agreements like FLAR, and there's regional companion institutions all over the world, can play a key role to multiply successful cases like the Costa Rican example. We have very high credit rating. We enjoy preferred creditor status. We're very close to the countries, and we can react very rapidly to their needs. What else is needed to make this multiply? First, obviously, strengthen our membership. More countries needed to be part of FLAR and also the other regional financial agreements. And besides that, we need new innovative mechanisms to strengthen our financial assistance capacity. For example, recycling SDRs that was mentioned by Leslie. I think that can be a substantial contribution to strengthen our capacity to assist countries. And also encashment mechanism like the one of the PGRT or the RST from the IMF that can make both the SDR's contribution and also capital contributions of countries part of their foreign reserves. So this, again, it will be a combination of increase our robustness, but also our resilience to be more innovative and more relevant to our member countries.
Thank you very much, Fidel. And I think we have, in this first round of the table, have some incentive that we can check. President Nikwe, I'm going to turn to you. We have heard about the capital market robustness and the innovative way to also free space in our balance sheets. And I want to commend an operation that the West African Development Bank has issued recently, securitizing a part of its portfolio. And what struck me is that it's in Africa. So please share it with the room, how you did that and how it can be probably useful to others.
Adama, thank you. Thank you for having me, and thanks to all for this, the quality of the panelists. I'll try to be brief. We have basically came to the observation that was previously made by Leslie, which was that the way public and multilateral development bank used to have been used to manage their balance sheet was very, very conservative. For good or bad reason, the bond is not here. So basically, meetings after meetings, summits after summit, we come to the conclusion that there are funding gaps when it comes to the funding of infrastructure, when it comes to funding of energy, agriculture, real estate, affordable housing, etc., education, etc. And again, summits after summits, we come to the same conclusions. So the idea is that basically, if we were to sum up the balance sheets of all our banks here, the total wouldn't be sufficient to fund the development of the world. That's clear. There's a lack of capital in this world. In this part of the world, there's a lack of capital. So therefore, we need to think differently. So the way we've been reacting to it and adapting the way we are currently managing our balance sheet is that we have implemented the so-called originate to distribute strategy, which literally means that after the origination of assets, quality origination of assets, restructuring of the project, underwriting, because we need large balance sheet to underwrite project, then the phase by which we would need to distribute the risk was essential. Distributing, first of all, the inner risk, the risk as it is, partially. But you cannot distribute the whole risk, the total risk, because you can't say on one hand, well, I like your risk so much that I would get rid of it. Doesn't make sense. Now, so the idea of keeping, what we call the skin in the game, keeping the skin in the game is essential. Because the risk, the credit, you would keep servicing the risk, managing the covenants, managing the credit even, etc., etc. So you would distribute partially the risk as it comes, as it is the inner risk. Then you would insure part of your portfolio, insuring part of your portfolio, and to be insured by AAA insurers, you know, the track, London track, Lloyd's track insurers, for example, are good insurers that are very accustomed to the type of risk we hold. But doing so, you understand that you would enhance the quality, the rating quality of your portfolio. Last thing, we have also this possibility to securitize. Securitize, technically, it means that we would transfer into an SPV part of our risk. We select a number of assets. We would transfer. Can be a true sale into an SPV. We would tranche it. We have decided to set up a cash reserve, a capital reserve, that would act as a first loss. Basically, it's a crucial step here because, you know, getting access to debt, you know, for bank like ours today, it's fine. The question is not debt. The question is the capital, the equity, which literally means that the day you have a diesel, the day you face, unfortunately you face, which is, I mean, this can happen. The day we face a default, you need to have someone sitting next to you and bearing the cost with you. If you have a senior debt bondholder, he wouldn't care about this. The only thing he would care of, I need my money back. And the problem we have is that most of the time, we even have cross-default triggers, which means that if I don't pay here, all my debt, all my outstanding debt will be called, which is another level of pressure. So the battle of the battles is the equity, the cash reserve. So that's what we have been working hard to set up a cash reserve, which again would behave and act, would perform as a first loss tranche. Then create a senior debt, which is basically issuing a paper, issuing a bond. This bond is listed, and we have made this bond eligible to the refinancing, to the central bank refinancing, which means that in terms of quality asset, this asset is of good quality because it's liquid and it's based on good quality project. We have been distributing these bonds. We have a program of $500 million or euro equivalent. We have so far succeeded for 2023 to execute half of it, $250 million. We have for 2024 another tranche of about the same amount. We'll also work on RMBS type of structure related, which is literally related to real estate, affordable real estate. So at the end of the day, we have succeeded in enhancing the velocity of our balance sheet, because most of our banks have been considering that if you hold a 10 years maturity risk, you have to hold it for 10 years, which is wrong, which is totally wrong. You don't need to hold it for 10 years. The second thing, we have released the pressure, lightened the pressure on the tier one capital. Therefore, we have made the same dollar equity tier one, core tier one dollar. We have used it and we have made it available for new debt issuances. So it is we have created a virtuous circle by which, from origination to distribution, we will recycle the capital and make sure that, you know, we will try as much as possible, and we believe that's a good way to reduce the gap, the funding gap, when it comes to the funding of our development work and the meeting and the tackling of the SDGs. I'll stop here, but basically that's the idea.
No, thank you very much, President. I'm not going to stop here because you tickled my interest on some of those points. Did it have any effect on your own spread of borrowing by, going through the SPV when the SPV issues? Do you get to have a lower spread or not? If just as it was the first operation, probably not. But
no, I mean, usually when you tap the debt capital market for the first time, market usually makes you pay an initial primary initial premium issuance premium. But basically, in this case, no, because the market knew us. I mean, we made it on the domestic market. It's local currency, regional investors. So we had no initial premium to pay. Absolutely not.
And your borrowers as countries, how did they feel with having their credit securitized somehow?
Absolutely, it was sovereign. Yeah. It was sovereign, which was counterintuitive for most of the investors, because people used to tend that sovereign countries never default. It is an assumption. It is an assumption that at some point, at the end of the day, sovereign countries will repay their debt. It is an assumption. So in theory, the assumption is that you have no default. The reality is different. The reality is different. So we've been through this. We've been beyond this, considering that, yes, we could bear a default, sovereign default, but it has been well received.
Thank you very much. I'm going to turn now to President Jean Leon from the Caribbean Development Bank. And we are moving to another issue we have here, is that Caribbean Development Bank is covering, a very exposed region, also, to climate issues. And we have heard lately many discussions around financial solutions in case of distress. You are very much engaged also in discussions around loss and damages and how MDBs can play roles in that as well. So my question to you is, all these MDB challenges also, I know that you have bring some proposal there on how to manage the debt stress. Tell us about that. Thank you.
Thank you, Chair. I want to use my time to address two questions. The first is, what is our reality? And the second is, what are we doing about it? And I'll be brief because I have the benefit of my colleague here who can do one of the bits for me with a little bit of detail. So what's the reality that we are facing? Between 2000 and 2019, so let's say the space of 20 years, the region that we work in had 190 disasters, climate-related disasters, that have had the impact of affecting over 2/3 of the population of the region. We've had loss of land, coastal, and marine biodiversity. We have had loss of life and loss of assets that have impacted water security, have impacted food security. We have had movement, displacement of peoples. We've had increase in the potential loss of living conditions on islands, not to mention significant economic decline, and importantly, an inability to recover because of the continuing nature of those events. As I said, 190. They repeat, and so by the time you recover, you already have another one on your doorstep. And so the most important thing that matters to us is, one, the vulnerability that one faces on a continuing basis, and the need, as Fidel was saying, to build resilience so that you can manage not only rescue events, but recovery events and your repositioning elements. And so that's the reality that we face. But importantly, it affects every element of our being. It's not just a climate event. So although we are saying it's the impact of climate, it impacts everything. And so the solution to the problem cannot just be solving climate. It has to solve everything at the same time. And that is the what are we doing about it, and why it is so important for PDBs, MDBs to be a part of this, because we have a unique and essential role to play in the development of those economies and people of regions. And so MDBs, PDBs have a significant role. So where do we enter the picture? We do that in 3 ways, and I will summarize them. The first is we cannot see development as reacting to climate. It has to be an entire holistic approach, which means that the entire paradigm of how we look at development needs to be changed, so that we need to be able to incorporate vulnerability and resilience elements in our entire development approach and policies. And so we have been doing this through working with the United Nations on the broad issues of the multidimensional vulnerability index and taking it beyond. And so the first point of ask here is MDBs, PDBs in aggregate should look to support that drive because of that unique role that you play. And as we go into the General Assembly this month in New York, your collective voice, I think, would be an important part. The second element that what we are doing relates to the fact that because you've had all of those disasters, because their effect has accumulated, and because they are going to continue as climate change continues to impact us, is we have significant loss and damage issues to worry about. And so as a result of that, and again, because of the unique nature of the PDBs, CDB has put in a bid to host the Secretariat of the Santiago Network on loss and damage to coordinate not only technical assistance, but equally the funding and the deployment of that on issues of loss and damage. And therefore, the second point I would like to again ask is, again, the PDB body fix could provide support in supporting that, because it now becomes for an institution serving development, understanding the issues around loss and damage that can be even more effective in helping us meet our particular mandate. The third thing that we are doing is related to what Leslie was talking about, balance sheet optimization. How can we better serve the countries in our region? I've pointed out that a large part of our problem is vulnerability and resilience building. And so the question is, how do you do that? And one specific element that we are working on now is to provide contingent related assets for all loans existing and new loans that are related to climate-related impacts and how they can be managed to reduce the impact that we are seeing around on fiscal and debt sustainability issues, but to recognize that doing that means higher risk, and that higher risk needs to be able to counter on the balance sheet of the institutions. So we are equally proposing, and we've won an award from the MDB Challenge Fund to explore that innovative finance element that Samia was referring to. How do you then design liability side aspects that match the increased risk on the asset side so that the net effect on your balance sheet remains neutral, and therefore those credit rating agencies that would, in a sense, penalize you will no longer be able to do this, and therefore your ability to mobilize funds and deploy for the benefit of those countries remains intact. And that's the work that we are doing with Lazard. So I don't want to go further into it. I will defer my time or part of my time to Lazard that will talk a little more about this. But those are the three things we are working on to manage the impact of the reality that we have now. And again, the third ask is that the fixed community can support that type of work, because it has bearing and implication and utility for all of our development banks. Thank you, Adam.
Most definitely, and we are in this together, as also we supported all the work by African Development Bank, IDB on the SDRs as well. Leonardo, so if you can probably keep up on the balance sheet optimization process you are brokering.
Yes, thank you very much, Adama, for the invitation. Basically, I wanted to outline two projects we are advising on, or we were advisors to. And the first one is the one Jean just mentioned. And the second one, it has been mentioned by different speakers, is about SDR rechanneling. And we thought it might be useful to say a word about this in this panel. So yes, first about this project we are developing with CDB. First, I must say this is indeed supported by the NDB Challenge Fund, which is a small fund which has been funded by three foundations, the Bill and Melinda Gates Foundation, Open Society Foundation, and the Rockefeller Foundation. And the idea is really to try to encourage financial innovations at multilateral development banks, building on the work and the reflection that have been ongoing at the G20 level, that has been mentioned also by different speakers. And so really, I mean, we would like to thank them, because it's really an enabler, I think, what they are doing. And also use this opportunity, of course, to thank Jean for his dedication, his leadership, and what he's doing at CDB. So about the project, I mean, Jean mentioned it, it's about climate contingent clause. Of course, those clauses are not new. I mean, pausing the service of the debt is not new. You have those clauses in DFI loans already, in some publicly listed instruments. For instance, in Barbados, Grenada, they have been issuing those type of instruments. In the past, you had significant debt relief offered by the Paris Club, for instance, when you had some catastrophic events back in 25 in Indonesia. So those are examples of a debt relief mechanism. Now, and also you had recently, and I think this is really welcome, some announcement by MDBs, World Bank, EIB, and others that are stepping in and wanting to do something in the field. So now what we are doing and what is new with CDB is, first, as Jean said, it's a holistic approach, and I'm going to explain in a few words what it means. And also, I think, and speaking under the control of Jean, the potential level of ambition we would like to achieve. So on this part, ambition, it means that we are testing different scenarios, including ones where potentially, this is still a study phase, but we will apply the clauses to the entirety of the stock. Which will be, of course, and of course it will apply to all the CDB borrowing members. And what we would like to do is, to offer this debt service suspension potential to all borrowing members, depending on the nature of the kind of climate shock they will face. And for that, we will rely on external data and potentially partner with institutions such as CRIF, which has some stochastic, assessment of the likelihood and the probability of occurrence of those events. And then to do some simulation to assess, to what extent the balance sheet of the institution will be affected, should we really go to such a level of ambition. And the difficulty is that you start operating in a stochastic environment, so you have to use financial techniques in a sense to really have a sense of how your portfolio, and especially the metrics that are monitored by credit rating agencies, how those metrics are moving, should you move to this level of ambition. And of course, when you start, granting some debt relief or granting some debt pause to your members, this creates some potential liquidity shortfalls. So you have to structure upfront an instrument, and here I'm coming to the liability part of the solution. You have to structure some liability instrument so that your indicators, equity, capitalization ratio, liquidity ratio, will be, as we move forward and as those clauses are triggered, will be maintained, within the adequate ranges, so that the credit rating of the bank will be maintained. So this is really at the core of what we are trying to achieve. Also, we do not want to restrain ourselves to just looking at NPV clauses. Those are the type of clauses that have been applied so far. We think we may want to go a bit further than that. For instance, testing ideas around maturity extension, not only capitalizing interest, and so there are a range of things we are currently doing. Under this project, we are going to release many materials publicly. So, other institutions that are interested will be able to look into it and to potentially, replicate that. I think it was the purpose of this MDB Challenge project.
Can we stop on the one example, because I think we won't have time to run the SDR part, but
yes,
for sure.
I was moving to the SDR part.
No, but I think we have a matter of time. So
okay.
if you may upload, yeah, sorry.
Of course.
But for sure, we will share it afterwards. Fine. Yes, go ahead.
So thank you so much for having me, and maybe I'll change the discussion from kind of the balance sheet side of the public development banks to how the public development banks can work more with the private sector, right? That's the mobilization agenda is a very strong one, and so I want to make some remarks on what we can do, what pathways there can be to work together from what I've experienced in the past 3.5 years at the JP Morgan Development Finance Institution. And I think the first thing I would say is that there is, I think, a value of leveraging standard products and structures, right? I know there's a big call to have innovation, and there's nothing wrong with innovation, but at the same time, using plain vanilla products goes a long way, right? When you're working with the private sector, they understand them, it's faster and easier to do. So examples are when the MDBs and DFIs have come in as anchor investors in bond deals, the market understands it, it works. When there's a guarantee provided for a project finance loan, people understand how it, how it operates, it works. Trade finance programs where we've worked with MDBs and DFIs, these are established, they can scale up. And that's to your point of how do you scale up financing for SDGs. So my first comment would really be, how do we use existing products and scale them up and, do it in a consistent and replicable manner? In that same vein, I think the other way to think about it is really to avoid as much bespoke, structures. It is sometimes nice to have blended finance, but it's not needed in every case. And when you do, call things what they are. If there's a securitization, call it a securitization. If there's a junior tranche, call it a junior tranche. If it's a first loss, sometimes using this terminology of blended finance, a lot of things, the private sector doesn't understand it the same way. It becomes very complicated. It becomes complicated to execute. It takes more time. And it is then almost impossible to replicate, right? So I think that's just another learning that I would like to put forward. The third is that there are existing structures, I think also for FX, for commodities, for interest rate hedging. And JP Morgan does this day in, day out, right? For many currencies, for different interest rates, for commodities. And I think to spend more time exploring how you can leverage the existing hedging and swap facilities that are out there would be something of value to this market. So I'll also turn to the fact that it's not just the financial products of the public development banks that is valuable to the private sector, but it is also the non-financial products and knowledge. So first of all, the on-the-ground presence, the local knowledge, the convening power of the public development banks is not to be underestimated, right? This is something that we value when we go to our credit committee, when we look at KYC, know your customer, and this really helps us understand credit risk, both real and perceived, right? So playing a bigger role in informing the market about what the risks really are is something that the public development banks do and can continue to do, and the private sector sees value in that. The second is that the public development bank should definitely continue advising governments, right? The key policy role that they have in helping bring about macro stability and also to improve the credit rating of the country, that is fundamental. And to improve the business environment of that country is fundamental. The private sector comes in when there is a stable policy regime, macro. This sounds basic, but this is not to be underestimated again, and this is not a financial product, this is non-financial. The other is research and knowledge sharing. I mean, just yesterday, there was a big there was a big database that was released. There are students all over the world that use the World Bank's WDI database, to give an example. That knowledge sharing and that openness of sharing data goes a long way, and that's something that the private sector also appreciates. And I think lastly, I want to underscore the important role played by the public development banks through their technical assistance and advisory business in creating bankable projects, right? That upfront work done by many development banks in structuring, putting together a sound regulatory framework so that deals can work is really valued and appreciated by the private sector. And what would be great is if that could be set up and the development banks didn't feel like they had to then come finance the deal, and they really left it for the private sector to do. So with that, I'll pause and wanted just to share some financial and non-financial ways that we can scale up and do more together in the emerging markets.
Thank you. Before letting San to wrap up, I just want to have one. You mentioned the risk and the risk appreciation, and many times within Finance in Common also we observe that banks finance bank. We have in our assets, banks, and on our liability, public development banks as well. So that means I think public development banks has an appreciation of what the public development bank risk is as counterpart. And that's where also this discussion about rating is really useful to have, even among ourselves, because we did it within AFD. We opened our portfolio and checked how many banks we have in our portfolio. And banks in developing countries sometimes. And the cost they have by mobilizing money through other DFIs is way much lower than the cost they have even in the private sector when they mobilize. But what we have observed is not the cost they mobilize from us, because probably we have access to constitutional risk growth. But the default in our portfolio is far way lower when it is public development banks that are borrowing from us than other financial sectors members. So that strikes me somehow. So how come they have lower default risk against me as a bank, and they have much higher probably cost than those who just have the benefit of having deposit, because the deposit, so they can regulate the price of the deposit and have a cost from the deposit. But as public development banks doesn't have that deposit, so they would mobilize either locally from the government or from other DFIs, and it costs way more, and they don't have that risk because they pay back the cost they are mobilizing. So that's a question I want to address to our partner here, Rafael from SNP, and I think it's not to you to bring all the answers here, but just I think the openness we can have on keeping this discussion ongoing around the community of public development banks with rating agencies would be really useful, and probably we can start this today.
Yeah, sure. No, thanks for having me. I think this part of how you can factor this good risk position in terms of your credit portfolio and so on, usually rating agencies factor that much more on the standalone rating. That's part of the rating construction. However, it's pretty common also for you to have constraints related with the ceiling of the sovereign, right? So many rating agencies look at that. And I think was mentioned here a lot about, okay, usually sovereign bonds are considered risk-free for many institutions, for the market in general. But in reality, are they? And the way rating agencies try to treat that is independent from how the market deals with that, is statistically how that works. What are the default rates for a sovereign bond that is BB, for BB minus? And that's how we try to apply in our models, and at the end of the day, in the ratings, how it affects the final ratings, right? But for sure, each house, like JP Morgan, will have their own credit analysis. For sure, they base in our credit analysis in some instances, sometimes on theirs or in the conjunction of both, right? And maybe what I can give more insights, because my experience is 11 years covering LATAM, right? And for 8 years, I was primary analyst of many development banks in the region. For 3 years, I'm now covering only sustainable finance already, right? But I can tell you a little bit of my experience on that. Some of the regulatory aspects, conditions for the region, I'm not sure that applies globally. Development banks usually don't have access to deposits, especially retail, common. And the sources of funding, of course, capital injections from the government. We have a lot of special funds, especially in Brazil, that covers a lot of this funding. And then you have, for most of the countries, sorry about this generalization, but you have ratings in line with the sovereigns, right? That may give development banks opportunities in the local capital markets, and in many countries also in the international capital markets, and also opening credit lines with private players. But we do see a lot of importance in the conditions that you see in the credit lines, as you mentioned, with multilaterals and development agencies, because you have longer tenor of those and better interest rate conditions on those terms. But something that more and more development banks are seeking is also sustainable finance. And that's painful, right? So you see a lot of development banks doing the region frameworks, committing to some thresholds on environmental aspects, right? So it's not just because you are financing a project, it's already sustainable because you're a development bank. And the challenge that I see is not only about funding gap, because the challenge that I see is, if you see how much of the credit portfolio of development banks can be labeled sustainable, is still limited, because the region still need to catch up on environmental practices in order to be able to be labeled that way. And it's not anymore about self-labeling. You need to follow a lot of international principles. You need to have a third party looking at those projects. You need to have verifiers looking at your impact reporting in your location, which must be exclusively to those projects. So a lot to cover. And then when you check each of the banks, still a lot of room to grow. But for sure, the role of development banks here is crucial. So when we receive a transaction, a sewage and water project, without a development bank involved, we don't see those environmental bars going up. When we receive from BNDES, from IFC, with IADB investing on board, that's different. Then it comes with thresholds for energy efficiency, It comes with water loss rates, commitments around it. It comes with soil contamination discussions. So, and that's not, you don't need to take this for granted. So sewage, water, solar, hydro, it's not already for granted that it's sustainable. It's a lot of technical system in there to work on.
Sure. Thank you very much. We are way out of time. Sal, please close up this.
Thank you very much, Adama, for giving me an impossible task. You told me wrap up this discussion. So this is a very rich discussions, perhaps. Because I thought initially I would try to sum up some of the points, but maybe let me take a slightly more helicopter view. I mean, we started with the very systemic problems, and then we have seen how some individual institutions are trying to address some of these systemic problems. And in my view, we have a bit 3 dimensions that at least I could identify. One is, how do you become more robust and you know, better at what you're already doing? So you're improving, constantly trying to improve your internal system. The second one is perhaps to go a step further, is to try to identify how you can internally try to create new ways of working and things that were not done before. I have to say, for an external person, you know, I'm from a think tank, ECDPM, looking at the financial ecosystem and trying to provide advice. It's very surprising to see this focus on project-to-project approach by MDBs in particular and by many public development banks. Of course, projects are essential, but ultimately we want transitions. So it's very strange that some of the IFC, MCPP type of approach with guarantees, portfolio approach, and so are not replicated at the larger scale. I wonder, you know, is it surprising that we don't go from billion to trillions if we keep trying to attract investors on individual projects and they have to screen each project to see if it's a good investment or not? So, you know, the notion of securitization, very surprising also that this is not more common. Now, when I talk to bankers, they tell me it is difficult, it's not attractive enough, we need to sweeten the deal for the private sector and so. But how it is not possible to do that more at scale? If we want to go to scale, how can we not attract more institutional investors to try to do this? And so I'm not saying anything new, but it is surprising that year after year, we know the same elements, but we don't change these business models. And so it's quite, you know, comforting to hear some of the bankers here who are saying, okay, we're trying to, within changing the system. The last part is that, and you know, I think all of you have mentioned, is we need to work together and we need to think global. So I would challenge that most of the, I mean, I think probably even all the PDBs, including the MDBs, are by themselves not able to go from billion to trillions and to go larger. So we should pay much more attention to, you know, issues like SDRs and systemic changes that could be coming. You know, could SDRs play a role in local currency, foreign exchange hedging, and so on? You know, we've seen the African Development Bank. I mean, change starts sometimes at the individual level, but we want to think about really systemic changes. And I want to conclude with two elements. One is on the role that, you know, ultimately banks and institutions are responsible to their shareholders, and their shareholders for public development banks are the public authorities, and that's the public authorities are accountable to the people. So ultimately, if we want to have changes, and probably that's also an issue for finance in common, we should not only have bankers and experts, but we should have the shareholders participating to these discussions. And to be honest, in most of the discussions I'm part of, I find the bankers these days are much more innovative than the shareholders, because the shareholders are, you know, either from the Treasury of the Ministry of Foreign Affairs, or depending where they come from and their background, they tend to have a narrower view. So I'm not talking about all the shareholders, but this is kind of in general. And then many do not understand some of the technicalities that are raised, especially at the higher political level. So this is one of the elements element. The second I wanted to mention is still the regulatory aspects that we have perhaps not covered enough. I mean, some of the public development banks, particularly the DFIs, are subject to Basel III. And so they do have a real different issues, you know, to go for more risky investment and so on, especially with the revision on the Basel. So at least that's what they are telling me. And here we have some systemic issues. The second one, that's more tricky, especially for somebody like me coming from the development side, and I stopped there, is about the sustainability criteria, because we all want to have more sustainable investments. At the same time, what we hear also from many developing countries is that if you keep adding a number of criteria for what is sustainability, you are likely to cut the funding that will go to these developing countries, because in fact it's easier to invest in an advanced economy, in a Western economies that, you know, where you are sure you will be meeting all these standards, that to go in a developing country where the risk of not being able to abide by the sustainability standards, you know, will be operated. So if you have private capital, large scale and so on, where do you go? You don't go to the developing countries where you need most of these finance. So I think at the time, and that also not for the bankers, but that's more for the regulators, we have to think about how we can have elements that on the one hand increase sustainability but do not act as a barrier to investment, because we try to have every country in Europe, we say, you know, you want to have every country should be like Denmark on a sunny day, and you know, with perfect governance, and that will not work out. So we have to find ways where we are able to do that in a much better manner, and it is urgent, because since 2015, Leslie was mentioning this, we have said we want to go from billion to trillions. We're almost 10 years later, we're not there.
No. Thank you very much. So, Chair, if you will allow me to, I mean, please. All right. Thank you very much, everyone, for attending. And let's stop here and go to eat. Thank you very much.